It's almost 11 a.m. in Hong Kong, 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. The yen strengthens for a fourth day. Falling Treasury yields boost emerging market currencies after fresh data sustains Fed rate cut hopes. China takes more steps to boost consumption with interest rate cuts on $5 trillion of mortgages expected this month. Xi Jinping urging officials to make sure the annual growth target is met. India's inflation unexpectedly accelerated in August, giving the RBI a reason to stay on hold. We ask Fitch Ratings whether that will further hurt the slowing economy. And we'll hear more on the Philippines' efforts to drive foreign direct investment to the nation from Undersecretary of the Department of Trade and Industry, Seferino S. Rodolfo. First, though, let's take a look at how markets around the region are faring. Well, after a bright start, looks like things are taking a bit of a risk-off tone. Avril Hong's in Singapore with a closer look. Avril.
Yeah, I think that's accurate. We're seeing Asian markets fluctuating against this backdrop of what the Fed is going to do next week, and indeed not quite tracking the Wall Street climb overnight. A couple of things I did want to highlight, though, before we talk a bit more about central bank action. Of course, these Chinese equity space, we yesterday saw it closing at lowest level since early 2019. It's flat today, but the bond space in China certainly has been catching a really strong bid, and amid this we've seen the yield on the 10-year hitting a record low today. In the meantime, the story is really about the US data. I mean, nothing really moving the needle in terms of the US PPI and how we saw it climbing, a bit of a pickup, but this is after the couple months before where we saw that downward revision, and then the jobless claims, also another pickup, all in seeming to reinforce the idea that we're going to see a Fed that can start cutting rates next week. And this is coming against the backdrop of the ECB that cut rates, but also reinforced its inflation outlook, even warning about some of these price pressures that could climb in the later part of the year. And then you have these expectations about the BOJ. Bloomberg survey, according to the majority of these economists that were polled, they see a move by the Japanese central bank by January next year. More than half see a December hike. So it is against this backdrop that we're seeing the euro climbing, the yen is catching a bit as well, the dollar is softer. Flip the board, because as traders position for the Fed to start its rate cutting cycle, you can see how that is playing out across the curve, particularly on the policy-sensitive 2-year. We're seeing that almost 5 basis point move. Bloomberg Dollar Index at its lowest level in 2.5 weeks. So let's get more with Mark Franklin, Senior Portfolio Manager, Asset Allocation, Asia at Manulife Investment Management. So, Mark, they could finally be cutting the Federal Reserve. What are you watching out for, apart from this 25-50 debate and the dot plots, the economic projections? What is the focus for you?
We think that the Fed will be most focused on making sure that the markets aren't surprised by anything. There isn't a bout of volatility in a run-up to the election. And therefore, what they're probably likely to do is if they go with 25, which is our base case, they'll signal that all options are on the table based on how the data progresses, which will allow the market to, broadly speaking, keep its rate cut pricing intact. And any shift out of this year into next year will be more of a shuffling of the deck chairs in terms of rate cut expectations.
But given what markets are pricing in and what your base case is, which is 25 basis points move, given that, what sort of cross-asset market volatility are we expecting then?
If they go 50, then the conclusion will be, what is it that they've seen that makes them want to start off with an accelerated pace? In general, the Fed doesn't start rate cutting cycles with a large move. It starts with an incremental move, then speeds up. So risk assets, in particular equities, may ultimately start to pause for thought and question whether the growth outlook, which is currently priced in, notably a soft landing base case, is a question, whereas bond markets are pricing in a pretty significant growth moderation, which is our base case, but not necessarily going into recession territory.
There's also the variable of the US election coming up in November. How do you factor that in, considering the US has got ever-growing deficits to think about as well?
It's a great question. There'll be certain sectors where there is a clear difference in terms of policy agenda. Energy is a case in point. It's likely that a Harris administration would continue the Biden administration's emphasis on making it more difficult to explore and produce new energy assets domestically, and therefore keeping a rein on productive potential. So that would have, all other things being equal, a stabilising and an upwards pressure on domestic energy prices, whereas the Trump administration would be all for trying to maximise the productive capacity and output of the domestic energy sector, which would probably, all other things being equal, place downward pressure on energy prices. So that's one area that we would look at for signs of differentiation. But on the point around fiscal policy, even though how they get there would be very different, both administrations are likely to result in an increase in fiscal deficits, and fiscal easing will be a continued path of action.
When do you think that starts becoming an issue more realistically for US Treasuries on the long end then?
It's a great question. I mean, for the time being, there are buyers out there that seem to be pretty confident and comfortable taking duration risk, certainly compared to a few months ago. The question really becomes the extent to which the fiscal deficits become unsustainable, and the questioning around whether it feeds through into the nominal growth potential of the economy. Then it becomes wasteful spending, and at that point the markets may start to question the validity of the policy platform, and the buyers may start to retreat, and that when will put pressure on term premium in the longer end.
Where do you put money to work at the moment? Because valuations in the US in particular are looking reasonably rich right now.
In equity markets, yes, we did see some rotation towards more defensive sectors in the last couple of weeks. There's a bit more residual value left on the table. But in the last few days, there's been a surging back of large cap growth again, which is where you start to see more extended valuations. We try and take a step back and look at secular themes, those types of themes which have the potential to generate high double-digit compound growth in some of the businesses that benefit from these secular themes. So one example would be demographics and aging populations. So those healthcare companies that benefit from pharmaceutical development which supports and caters to that demographic shift. We also think cybersecurity is a theme that's here to stay because of the continuing suspicion aroused from geopolitical tensions, and therefore governments and companies having to invest in protecting their digital as well as their physical infrastructure. And then we look at the energy complex as well, and we think that nuclear energy is galvanizing a high degree of cross-governmental support in many countries, and that's going to create a strong investment pipeline for power generation companies that have a nuclear footprint, and also the feedstocks that go into it. So uranium, the commodity that's seen structural underinvestment and new supply as well. So we're thinking a slightly longer term and building our equity exposures around those secular things rather than risking getting caught up in some of these sector rotations as we approach the election.
So longer term, what about the dollar? Do you see fiscal policy, more so than monetary policy, being dollar positive or negative?
It's a relative game. So if we come back to monetary policy, the reason why we've seen some dollar softness in the last few weeks is that rate differentials are narrowed. If you look at what's being priced in now, something like 250 basis points of rate cuts have been priced in for the US over the next 18 months. And that's actually higher than it's currently priced in for the ECB as an example. So that's why you've seen a bit of a weakening dollar against the euro, and particularly against the yen as well, because of that rate differential narrowing. But actually, if some of those rate cuts do eventually get priced out, either because inflation starts to creep up again or because the growth outlook starts to improve, then you start to see some support coming in for the dollar. And don't forget as well, the reserve currency status, in spite of a lot of the commentary that you're seeing in markets, the reserve currency status is still very much intact, and that creates a natural demand and a bid for dollar as a currency, but also as a safe haven asset.
Will the euro outperform, though, into the end of the year? You think there's space for that, especially given how perhaps the yen is kind of a potential outperformer as well into the rest of the year? Our M Life question of the day is it going to be the euro?
Yeah, well, we take the ECB as a classic case where a central bank has effectively absolved itself of the responsibility of trying to be forward-looking. They're basically being reactive now, data point to data point. And that's why we think, actually, the number of rate cuts in the Eurozone relative to the US are underpriced. If anything, we think that the ECB is more likely to have higher numbers of rate cuts than the US over the next couple of years because the growth outlook is more modest. But in the short term, there's clearly a perception that the Fed will cut more, and that's going to provide some near-term support for the euro. But over a medium-term horizon, it's hard to envisage how the euro could meaningfully outperform the dollar when you look at growth dynamics and also the fiscal policy platforms of both candidates in the US election.
That's interesting, that nuance between perception and reality. But wanted to get your thoughts as well on the Japanese yen. How much do you think the Federal Reserve is going to have to trim things in order for there to be meaningful repatriation of capital into Japan?
We go back to market pricing. At the moment, if you look at one-year OIS or swaps in Japan, they're only pricing in an extra 30 or 40 basis points of rate hikes in the next year. That's highly achievable when you look at wage developments and price or inflation expectation developments in Japan. So it's quite possible that the Bank of Japan may modestly surprise on the upside in terms of rate hikes, whereas the Fed may also surprise to the downside in terms of the number of rate cuts that they put through. So on that basis, it's going to be a little bit volatile, but there is a modest asymmetric bid in favour of the yen, we think, on a near-term basis, which could precipitate some capital repatriation back to Japan. But then FX crosses are not just about rate differentials, they're also about growth differentials as well. And the nominal growth outlook for Japan continues to be very anemic. And also, if you look at the US as well, a muddling through growth picture. So we think that there could be some modest further appreciation of the yen, but not quite with the same velocity that we've seen over the last couple of months.
We think about it as normalization of policy, right? So when is that hike going to come in your mind? Is it going to be October, December, January?
They'll probably wait to see what the Fed does and says next week, not just in terms of the rate move, but also the signaling about future rate moves. If they perceive that the Fed will stick with a 25 basis point path, then they'll probably be happy to go before the end of this year. But if the Fed does cut 50 or signal that it would consider cutting 50 at some point, the Bank of Japan and Ministry of Finance might be a little bit worried about the pace of appreciation, which is ironic because they were worried about the pace of depreciation not so long ago. So they'll probably be more comfortable moving up if they think that the Fed is on a steady path rather than an aggressive cutting path.
Really interesting. OK, Mark, stick around. We have many more questions for you. Mark Franklin of Manulife Investment Management. Paul.
Well, still to come this hour, we will discuss the outlook for trade and foreign investment in the Philippines with the Undersecretary of the Department of Trade and Industry, Seferino S. Rodolfo. Plus, Fitch Ratings joins us for a closer look at India's BBB- long-term credit rating and the economic outlook as well. This is Bloomberg.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25, 50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
China is said to be poised to cut interest rates on more than $5 trillion of outstanding mortgages as early as this month. The move could help reduce borrowing costs for millions of families and spur consumption. China correspondent Min Min Lo joins us now with more. So, Min Min, how big are the cuts that we're talking about, and what sort of impact could they have?
So we're learning that banks are preparing for a mortgage rate cut of as high as 50 basis points. But Bloomberg has previously reported that there could be a two-step cut of a total of 80 basis points. And what this does is it would shift the timeline forward because banks normally reprice the mortgages only in January. But the first stage of that cut could come as early as this month. And this would impact those existing homeowners because we know that China has already lowered interest rates or mortgage rates to record lows this year. but that has mainly benefited new homeowners. But existing mortgage rates is still about 80 basis points higher than the newly issued loans. So this would save homeowners about 300 billion yuan in interest payments annually, and that could translate into 0.6% in retail sales, 0.2% in GDP growth. But bear in mind, this comes with a big caveat because the economic modeling is based on the assumption that all of that interest rate savings is then translated into spending. But at this current economic climate, we know a lot of people might put them in the banks as savings instead. And what it would do for banks as well is to cut the profit margins for banks, which is already at record low. In June, it was 1.54%. So this is essentially a national service for the banks to transfer wealth from the banks to consumers.
And Min, as we search for more clues on the health of the Chinese economy, among the things we'll be watching this weekend is a slew of data. What are we watching out for?
Yeah, I think we will find more evidence that the recovery is still not picking up pace in August. If you look at the economist estimates for August, we're looking at broad weakness across the board for fixed asset investment, retail sales. Industrial production is leading declines, expected to grow at 4.7% versus 5.1% in the previous month. Retail sales only expected to grow at 2.5% versus 2.7%. And that's particularly disappointing because in August, we were expecting a boost to retail sales because of the summer travel season, but it looks like the expectation is that even that is not going to be enough to offset some of the weakness that we're seeing. But retail sales is something that we want to pay attention to because it did beat expectations last month, so we want to see if there's still going to be surprises to the upside that would be good for momentum. But fixed asset investment, that's where we're seeing slowdown as well, and traditionally government-led investment has been able to cushion the weakness in private investment, but now we're seeing that the sale of local government special bond is at its slowest pace since 2021. So that's a bit of a concern as well. You have President Xi appearing on state TV, calling on provincial leaders to really properly implement all the policies for quarters 3 and 4 to ensure that the economy can hit the growth target of around 5% this year. This coming as economists have been shaving off their growth forecast for China. The consensus is now 4.8% growth for the year.
All right. Thanks so much, Min. Bloomberg China correspondent Min Lo. Let's get back to our guest, Mark Franklin, Senior Portfolio Manager, Asset Allocation Asia at Manulife Investment Management. So, Mark, as we look at the data out of China that's due, it's almost become a non-story in the sense that it's just bad. Increasingly, whatever data is coming out is just reinforcing the market negativity. What are you watching out for?
Well, we're looking at the negative wealth effects that are coming from the real estate sector, specifically prices that continue to moderate, the fact that the stock market over a 5-year basis has not really generated those positive wealth effects for households. So the consumer and the household is still cautious and they're still focused on replenishing their deposit or their savings balances after the years of COVID lockdowns and the economic inactivity. So how do you reignite the consumer and the household to be more confident to invest? You know, cutting borrowing rates on mortgages, they've tried that before, and China's not actually experiencing a disposable income or a cost of living issue. It's more about the animal spirits, the confidence about the future. And as Min pointed out as well, we also have to think about what the implications are for bank profitability. Margins are already very, very thin. They don't fully compensate for the loan loss ratios that you might experience at this point in the cycle. So it is important that they try to stimulate household and consumer sentiment, but not at the cost of other critical parts of the economy as well.
Yeah, in terms of reviving animal spirits, the policies undertaken so far just really haven't done the job. What do you think is needed here, and what would you need to see happen to persuade you to increase your allocation?
Effectively a rollback of the last few years of regulatory and oversight pressure on the private sector. If Beijing was willing to effectively empower the private sector to innovate, to capture the benefits of innovation and to incentivize entrepreneurship, that would go some way towards re-stimulating job creation, but also encouraging and incentivizing risk-taking. So that's an important measure. The other thing as well is really trying to put an aggressive floor underneath the real estate sector, given that a high minority of household wealth is captured in the real estate market. Finding ways to put a floor underneath these price declines and to try to reinvigorate selling volumes and selling activity in the secondary as well as the primary market, those would be important steps to take.
Is the 5% GDP growth target realistic?
We think that by the end of this year, the official numbers that come out will be broadly in line with that target. I think of critical importance will be what does the political centre signal in terms of the growth targets for beyond this year. Are we likely to see further incremental shifts lower? Because on our estimates, whether it's as a result of demographics or as a result of the high savings rate in China, we do think that China is on a path of longer-term potential growth starting to moderate from 5 to high 4s to mid 4s by the end of this decade.
When you look at asset allocation, obviously the Chinese bond market just can't stop, won't stop. The yield on the 10-year hitting record lows today. What is your sense of the intervention that we could get from Chinese authorities?
Well, what China is concerned about is the perception that it is in a deflationary cycle, hence the bid for bonds, the rally in yields, and the shift towards a lower bound of closer to zero. They want to avoid that scenario because of the second round order effects that that creates. And so one of the things that they have talked about is stepping into the secondary markets to either sell bonds into the market or to provide ways to allow the curve to steepen. But the other area of focus should also be on credit, because actually the credit quality issues of the real estate sector in particular several months ago was really the focal point for investors. That has since calmed down somewhat, and actually there is a renewed focus on looking for carry in Chinese assets, both hard currency and local currency. So that's an area that they could also focus on, is not only making sure that they put a floor underneath sovereign bond yields, but also allow credit spreads to come in, particularly in the high-risk parts of credit markets.
Okay, Mark, really great to chat with you today. Thank you for coming in and sharing your insights with us on these range of markets. Mark Franklin of Manulife Investment Management. Plenty more ahead. This is Bloomberg.
Here are some of the top political stories we're following. Donald Trump has ruled out more debates with Kamala Harris's odds of winning the presidency have risen following the showdown with Donald Trump in the recent debate. She's calling for another face-off. Meanwhile, the Department of Justice says Russia, Iran and China are increasing attempts to stoke divisions within the US ahead of November's election. A senior US official has warned European allies that Chinese companies are increasingly involved in boosting Russia's war economy. Biden administration officials are touring European capitals to share information with partners about China's cooperation with Russia and potential implications. The US president hopes to unite European allies on the issue. China's rejected US accusations of supporting Russia's war. Let's take a look at how some of the stocks are moving in the Asia-Pacific at the moment. You're seeing some iron ore names on the screen there. Fortescue Metals here in Australia doing particularly well, better by more than 4% at the moment. Fortescue is a pure play iron ore miner, and this is after we've seen the iron ore price extend a rebound. It did sink below $90 a tonne at the start of the week, but it's bounced off that, hovering around the $94, $95 level at the moment. A couple of factors here. We are anticipating likely easing from the US Federal Reserve, but also there is an expectation that Chinese demand could rebound as well. And in that respect, we're seeing China property stocks doing pretty well also. Bloomberg reporting that China might start cutting the rates on $5 trillion worth of mortgages as soon as this month. Could happen in a 50 basis point increment, or maybe two steps of up to 80 basis points. Could save Chinese homeowners 300 billion yuan in repayments, which hopefully they go out and spend. Up next, the Philippine Undersecretary of the Department of Trade and Industry going to be joining us for an exclusive conversation. This is Bloomberg. Let's take a look at markets in China as they head to lunch. We're seeing a bit of flatness, really, if that's a word, in the CSI 300, just better by a couple of points at the moment. We did mention China's plans to bring relief to mortgage holders, possibly as soon as this month. We're seeing bond yields in China, though, sinking towards record lows again, and this is despite state banks becoming even more active in selling bonds into the secondary market. Got the Shanghai Composite just a little bit weaker as well. All right, let's get to the Philippines now and their efforts to lure foreign direct investment into the nation. China Show co-anchor David Ingles joins us now with more. David.
Yeah, absolutely, Paul. In fact, it's a interesting point to have this conversation, really, with how that interest looks like in terms of foreign direct investment into the country. Particularly given some of the sort of the tensions that we talk about here on the shows. We're joined here in Hong Kong with the Philippine Undersecretary of the Department of Trade and Industry, Seferino Rodolfo, and as you can see on your screens as well, is really a graphic of what FDI has looked like that goes back to about 2010. Yellow line is your average. We've seen certainly a retracement somewhat lower in recent months. Is that an aberration? Do things pick up again? Moving forwards, the Undersecretary, of course, is in town. He's been meeting investors in Hong Kong. And I understand, nice to see you, by the way, and good morning.
Good morning, David, and good morning to all of our viewers.
Thank you for taking the time to speak with us. And I understand from your team that you came from mainland China. You're also meeting investors today. So how's the trip been so far?
We've been to Xiamen, to Beijing, and now last stop is Hong Kong. Very good, very strong interest, particularly in areas where the Philippines is really promoting, including renewable energy, battery systems, electric vehicles, high-tech manufacturing. Yes, very good interest.
That's good. Okay, I mean, certainly when on the China Show, we talk a lot about how these are growing industries, right? Yes. Renewable energies, electric cars, what have you. Are there specific companies that you're speaking with, for example, that have expressed interest in investing?
I could not mention their names, but definitely some of the biggest companies in China, in particular in these particular areas.
Okay. And the conversations are around what? The Philippines as an export market, or is this in terms of actually coming in with CapEx investment to build manufacturing capacity?
Philippines as an export market is already there.
Okay.
But the discussions now is really putting up manufacturing facilities in the Philippines, both for the domestic market and also using the Philippines as a hub for the Southeast Asia region.
Right. I need to ask you, and I'm kind of sure what you're going to say here, but entertain us for a moment. BYD. That's a name that's been brought up. And I think the Philippines was one of the 3 other places where it was looking to make an assembly plant. Are those talks still active with BYD?
Well, still active, but in terms of Philippines as a market. But the second biggest EV manufacturer, that one is active for manufacturing and assembly in the Philippines. Sorry, not BYD, but the second one.
The second one?
Second biggest.
Can you, first letter of the company's name. I'm kidding.
Sorry.
Okay, well, the other thing I want to talk about as well is, EVs aside, CATL has also been brought up as a potential name that you guys are speaking with. I was wondering if you could comment if there are active talks with CATL.
Not CATL, but the supply chain for CATL. As you may well know, David, the Philippines were rich in green metals. So there's no choice actually for Chinese companies, Korean companies, but to talk to Filipino companies and the government for green metals, green minerals, and further processing for the supply chain.
Okay, so these are active conversations.
Active conversations, yes.
Is a potential announcement possible to hear from you guys within the next 12 months? I mean, how far along are these conversations?
Yes, within the next 12 months, definitely there will be announcements, in particular on high-pressure acid leach factories. Maybe we're hoping that we can have three more in addition to the 2 that we have that are being run by the Japanese.
Is it surprising to you that the tensions between the 2 countries politically, has that shown up in your discussions? Has that affected in any way ongoing discussions, potential discussions that you've had?
First of all, just to say that the tensions are serious. Okay. We're treating them seriously. These are grave matters, and that is why also big effort from both sides are being put on this. But second, when it comes to business, this is something that we can really discuss. Discussions are ongoing because the complementation is just very fundamental. So you could see that businesses are continuing to thrive. Investments are coming in the Philippines. Yes.
And how large are these investments, roughly? Just give us a ballpark of the ranges of the types of capex we probably could see from China.
Yes. Just for example, just on high-pressure acid beach, that's nickel processing, investments would be in the ballpark of $2 billion per plant.
Per plant. How many plants are talking? You mentioned three on top of the existing two.
Three on top of the existing, yes.
Okay,
yes.
okay. Japan has also been, and just to pivot the conversation there to Japan as well, we've seen closer relations between the two countries, the Philippines and Japan. Can you give us an update if you're seeing any more active interest there from the Japanese?
Yes, most definitely. Also, they are also actively looking at the Philippines as a source for minerals and for mineral processing.
Okay.
In addition, of course, also to high-tech manufacturing, in particular for semiconductors and electronics. Yes.
So it's not just a business processing outsourcing story.
Oh, first, just to say that BPOs in the Philippines continue to thrive.
Okay.
We expect even doubling of the workforce. We are positioning the Philippines in terms of a country that is ready for AI. For within the next 5 years, we will be doubling our workforce when it comes to BPOs. But in addition to that, that is a very good pillar for our economy. We are really looking at transformative industries, as I mentioned, including on renewable energy, data centers, green metals and green metals processing, electronics and semiconductors. Yes.
Does the Philippines have the skill set in terms of the labor force to upgrade its part in that value chain across these sectors, to your point?
That is most definitely a challenge and an opportunity for the Philippines. As you may well know, the Philippines were among the youngest in terms of our population. The average age of Filipinos is 25.6. And that the opportunity there is really to upskill towards more of these green and more sustainable and connected jobs.
Yes. What's the government doing to help that upskill? Because everyone in Southeast Asia, except Singapore, is young. So that's not really a factor that's unique to the Philippines.
Yes. Most importantly, one is our partnerships with countries like the US, Taiwan, South Korea, Japan, also with China. And then very important is our partnership with the private sector. So that is our way forward.
And it's not a new issue. A lingering challenge that foreign companies have brought up, and I'm sure you're part of the conversations, going into building and expanding their manufacturing capacity in the country, are expensive energy costs and power costs as well. Is that still a big issue, number one? And number two, what's the government doing to lower that further?
Actually, that's an opportunity for the Philippines because, as you may well know, power costs in the Philippines is high because we do not subsidize. But as all countries now need to remove the subsidies, the Philippines can be more competitive in terms of traditional sources of energy. But in addition to that, the Philippines were moving really towards renewable energy. Just for context, David, our investments in the Board of Investments, 1.26 trillion last year. That's the highest ever in our 56-year history. January to August, we're already doing 1.22 trillion. And about 90% of that goes to renewable energy.
Right.
So this
is Philippine peso, just to...
Philippine peso.
Okay,
sorry.
okay, go ahead.
But that's why the shift towards more sustainable is really something that is an opportunity, and it levels the playing field for the Philippines.
Is there a specific energy mix, since you brought it up, energy mix that you're targeting, and by when? For
okay, solar, wind, both onshore and offshore, and then geothermal.
Okay.
So those are our, of course, in terms of timelines, the offshore wind powers will take about 6 to 7 years, but the solar are there being implemented, and within 2 years. In fact, the biggest solar power project in the whole world will be in the Philippines.
You probably alluded to this, I'm not sure. Looking at solar, for example, are these mainly going to be Chinese suppliers, for example, that will get involved in this process?
Right now, yes, Chinese supply chain goes into the solar, but we are also getting investment in terms of manufacturing of the solar power cells and the modules.
Final question for you. I need to ask you this as well. The message as you go abroad, you meet foreign investors. I need to ask you about corruption.
Okay.
Can you guarantee that foreign companies will not pay a single cent to grease the wheels, as they say?
Yes, 100%. You will not be asked to pay anything more than the official official cost. So no corruption in the Philippines.
Thank you
Guaranteed.
so much. It's nice to see you. Let's do this again. Seferino Rodolfo there, of course, guys. Philippine Undersecretary of the Department of Trade and Industry here with us, of course, in Hong Kong. Avril.
Great stuff, David. Thanks so much. China Show co-anchor David Ingles. Now, let's take a look at how Japanese markets are faring. Of course, it is a day where we're seeing most of the region in positive territory, but taking a look at what we're seeing on the Nikkei and the topics, it is a negative day. That 3% surge just a day ago on the Nikkei looking really short-lived, and it's the tech and automaking related stocks that are taking a hit as the Japanese currency continues its climb. Of course, this is coming against the backdrop of the extension of losses in the US dollar that we're seeing in the Asia session. Of course, overnight, in terms of data, US PPI only showed that slight pickup, and that was after downward revisions, and then jobless claims also pick up for the first time in 3 weeks. So all in, you get the sense that the Fed is all systems go next week. And against that, you also have a Wall Street Journal report just talking about how the Fed could still be considering 50 basis points, right? Just the idea of if it's going to do 100 this year, why not start big? It's not just the Fed that we're watching next week. Flip the board. Also wanted to rake through some of the expectations from BOJ watchers based on a Bloomberg survey of about 50-plus economists. The majority of them see a hike from the Bank of Japan by the end of January, and more than half see one by December this year. No change expected at the meeting next week. Of course, this is too soon, most think, given the hike that came in July, as well as still the markets digesting those ructions after that move. Paul.
Thanks, Avril. Just want to get you across that breaking news. You might see the red headlines down the bottom of the screen there. Blackstone said to be considering a sale of the visa firm VFS. This is according to people familiar with the matter. A potential transaction could value VFS at about $7 billion. VSF Global is headquartered in Zurich and Dubai. It provides governments with administrative solutions for processing passport applications and visa consular services as well. The company's processed getting on for 300 million applications since 2001. So Blackstone said to be weighing the potential sale of that visa firm that will be worth $7 billion, said to be holding early talks with advisors on the sale of VFS. All right, still to come. Fitch Ratings going to join us. We will be discussing their latest views on India's sovereign debt and the country's long-term outlook. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You are watching the India Focus. We're about a minute and a half away from the open. Here's how we're looking in the pre-market. Modestly risk on day. We've got the Sensex better by about 0.1%. The Nifty Bank Index better by about 1/3%. Well, India's inflation unexpectedly sped up in August, and this is giving the central bank a bit more wiggle room to stay on hold, as it has been for more than 18 months now. Let's dig into the data with South Asia economy editor Ruchi Bhatia in New Delhi. So, Ruchi, inflation a bit stickier than expected. How is the RBI looking at the price pressures at the moment?
In fact, the central bank has been saying, Paul, that the last mile disinflation is, proving to be very, very sticky. In fact, inflation is below the central bank's target aim of 4% for the second month in a row, but it did unexpectedly accelerate a little bit, mostly on account of volatile food prices. And this, of course, is going to give the central bank more ammunition to really keep rates on hold for a little while longer. Any which ways, the economists don't expect the central bank to move, any time now. In fact, they believe that the central bank will move only perhaps after the US Fed indicates, what their way forward is going to be with respect to the loosening of monetary policy. Having said that, Governor Shaktikanta Das has said that any premature rate cuts will hurt the Indian economy. But on the other hand, there is also clamor that we will will see the growth slowing, something that is getting reflected in the data as well. In fact, if you look at the last quarter's GDP number, that has started showing that growth perhaps is slowing on account of various factors. And this is something that the RBI will have to consider sooner than later. But for now, they're totally focused on inflation, and the commentary going forward in the October monetary policy is something that we will have to wait and watch out for.
All right, Bloomberg South Asia economy editor Rishi Bhatia there. For some more perspective on India, Jeremy Zook, Asia Pacific Sovereigns Director at Fitch Ratings, joins us now. And Fitch recently affirmed India's long-term BBB- rating, keeping the outlook stable as well. So, Jeremy, if we take a look at India, it's got the world's fourth biggest pile of foreign reserves. It's got fairly negligible dollar liabilities at the sovereign level as well. So how do these sorts of factors play into your rating considerations?
Yeah, that's right. When we look at India's rating profile, its external finances are a very clear credit strength for the India sovereign. As you mentioned, relatively modest current account deficits, and that's really underpinned by very strong performance in service sector exports. You have very solid foreign exchange reserve buffers that the RBI has built up over several years. And when we look at those external liabilities, India, doesn't have much risk there. And, our view is that this has really helped India manage the significant amount of global volatility that we've seen over the past couple of years. And we really expect that to be sustained in the coming years. And we think these very strong external finances give quite a bit of buffer for India to manage, again, some of the external volatility that we may see going forward.
So in terms of potentially getting a boost to that rating down the track, what needs to be done to get there?
Well, look, in our latest rating review, we did note that there's been quite a lot of positive momentum in many of the credit metrics that we look at, certainly on the growth and the external finance front. Even on public finances, there has been some progress in addressing the challenges there. But that being said, those public finance metrics really remain a bit of a credit weakness in India's profile. And we'd like to see a bit more evidence that we'll see those structural weaknesses on the fiscal side addressed more sustainably. So if we think about kind of India's general government debt metrics compared to its rating peers, deficit of about 8% of GDP, debt at about 82% of GDP, and importantly, an interest-to-revenue ratio of about 25%. These all stand out quite a bit on the negative side compared to those peers. But we have seen recently, I think, an increase in fiscal credibility, an increase in fiscal transparency. And in our view, that does increase the likelihood that we will see some of these structural fiscal challenges in India's credit profile being addressed in the medium term. So, for instance, when we look at the debt to GDP metric, this is really a key factor for us, whether the government is able to bring this steadily on a downward trajectory. And so we're looking at really more evidence that, again, the government can continue on this track of fiscal consolidation, continue with its fiscal credibility, and bring down that debt ratio.
Jeremy, to your point, I think India has done a pretty solid job in meeting its fiscal deficit targets. But what are some of the vulnerabilities for it when it tries to meet some of these targets?
So we think there's really two key vulnerabilities. The one is on the growth side, and the other is on the political side. So when we look at the growth side, some of the risks there, certainly revenues have been very buoyant over the past several years. And this has really helped India to bring down its fiscal deficit while continuing to boost some of its infrastructure spending at the central government level. If growth were to start to underperform, that could have some impacts on revenue going forward. And I think further to the point on the growth side, the government's CapEx plans have really helped to support growth over the past couple years. And we are expecting the private investment cycle to really pick up and take the baton from the central government. and this is really going to be a key factor in consolidation going forward. We think the government will have to cut back a bit on its infrastructure agenda. But if the private capex doesn't pick up, then that may be a bit of a challenge, and the growth and fiscal consolidation trade-offs become more difficult. On the political side, the government has remained very committed to fiscal consolidation, even given the election results. We expect that to continue, but over the longer run, there is always a political risk of more populist spending measures, but that's not our base case at the moment.
What about your view on the rupee, Jeremy? I mean, you look at the current account dynamics, they seem pretty favorable. We're seeing plenty of inflows. Well, it's petered out recently, but still quite solid into the Indian market. You look at Brent, roughly below 70, or hovering around that level. What's the outlook there?
So our outlook for the rupee is essentially a very stable outlook. We expect about 83.5 to the U.S. dollar by the end of this year. Those positive tailwinds for the rupee, adding perhaps a bit of strength to the INR. We still think, though, that the RBI has demonstrated quite a preference for relative exchange rate stability, and we think that the government or the RBI will, focus on using some of those tailwinds that you mentioned from inflows related to bond index inclusion, the lower current account deficit. We think the RBI will take that opportunity to continue to build up its already very robust foreign exchange reserves. And so in that sense, we expect a relatively stable outlook, just a very modest appreciation through the end of the year.
All right, Jeremy Zukov, Fitch Ratings, thank you so much for joining us. Let's take a look at how Indian markets are tracking. We're about 7 minutes into trade, and we're seeing a little bit of lack of conviction, really. Sensex off by just a few points. The Nifty Bank Index broadly flat. It's kind of reflective of what we're seeing around the Asia Pacific more generally as a whole. So India off to a soft start this Friday afternoon. We have plenty more to come. This is Bloomberg. Let's get you some breaking news out of Hong Kong. We're hearing from Medea Group, said to be poised to raise $4.6 billion in a Hong Kong listing. This is the Chinese appliance giant. So this is an enlarged deal. It would price that listing at the top of the marketed range. This is according to people familiar with the matter, but it just shows the appetite, the demand for what would be the city's biggest share sale in 3 years. So Medea said to be poised to raise around about $4 billion in that Hong Kong listing. Prices at $54.80 per share. Right, let's take a look at markets in the Asia Pacific this Friday morning. It's Friday afternoon here in Australia. Australia being one of the few markets in positive territory at the moment, better by about 1/5%, but we're seeing a fair bit of weakness elsewhere. The Hang Seng Index, an exception to that, also better by 1% right now, but the Shanghai Composite off by a few points. We do have gold stocks doing quite well, however. Take a look at Evolution Mining, better by 8.3% here in Sydney. And we did, of course, see gold hitting a record above $2,500 an ounce. Regis Resources also better by 6.5%. Right, let's take a look at a couple of other stocks we're watching. Korea Zinc also jumping by a record. This is after MBK launches a tender offer to buy Korea Zinc. That follows a deal that would make the private equity firm the largest shareholder there. We've also got news of GM and Hyundai signing a deal to explore new joint vehicle development. Both those stocks performing very strongly at the moment. That is it from Bloomberg Markets Asia this Friday. Horizons Middle East and Africa up next. This is Bloomberg.